Welcome. Today, we're jumping right into a really disciplined intraday trading strategy. It uses a very common indicator, the RSI, but in a way that you might not have seen before. The whole idea here is to find a clear, repeatable method to cut through all the news of the daily charts. So if you're ready to stop guessing and start using a concrete plan, let's do this.
So this is really the big question, isn't it? Intraday trading can feel so reactive, so chaotic. But having a solid strategy you can use again and again, well, that brings some much-needed order and control. We want to move from just guessing to actually executing a plan. So how do we build one?
All right, here's our game plan. We're going to cover 6 key things. We'll kick things off with a mindset, which is super important. Then we'll get into the real nuts and bolts, the 2-time-frame strategy, the exact entry rules, and how to manage your risk. After that, we'll look at real-world examples, both winners and losers, and we'll wrap it all up with the key takeaways. Okay. First things first, before we even pull up a single chart, we have to talk about mindset. Because in intraday trading, your headspace is just as crucial, maybe even more crucial, than any strategy you could possibly use. You know, a lot of people get into intraday trading thinking it's all about fast, easy money. But the reality, it takes an incredible amount of discipline and patience. This idea that you can just find some magic strategy and start printing cash, it's a complete myth. The truth is, psychological stability is what really separates the consistently profitable traders from everyone else. All right, now let's get into the heart of the strategy itself. We're going to use a 2-time-frame approach, and what this does is help us filter out all that market noise and get a much cleaner signal. It's all about combining the big picture trend with a really precise moment to get in. The official name for this is multi-timeframe analysis. And look, think of it this way. The higher time frame, like a daily chart, is your map. It shows you which direction the highway is going. The lower time frame, our 15-minute chart, that's your GPS. It tells you exactly which on-ramp to take. When you use them together, you make sure you're trading with the big trend, not fighting against it. So let's break that down. The daily chart has one job and one job only, to tell us the direction of the main trend. It's our go or no-go filter. The 15-minute chart is where we hunt for our specific entry signal. And here's the most important rule. We only start looking for an entry on the 15-minute chart if the daily chart has already given us the green light. So, how do we turn all this theory into a specific, actionable rule? Let's walk through this simple 2-step confirmation process for actually entering a trade. This is where it all becomes real. Here it is, the core of the entry rule. Step 1, we look at our daily chart. We're watching the RSI, the Relative Strength Index. Now, a cross above the 60 level is widely seen as a sign of strong bullish momentum. If and only if we see that signal on the daily chart, we then move to step 2. We zoom into our 15-minute chart and we wait for the exact same signal, an RSI cross above 60. That's it. That's our trigger to enter. No daily signal, no trade. Simple as that. Look, finding a good entry is only half the battle. Seriously. A strategy without a risk management plan isn't a strategy, it's just gambling. This part is all about protecting your capital, which is, without a doubt, the #1 job of any trader. This right here is the mathematical foundation of our entire risk plan, a 1-to-3 risk-to-reward ratio. This rule is absolutely non-negotiable. We only even consider trades where our potential profit is at least 3 times bigger than our potential loss. I mean, think about what that does for you. It means you can be wrong more often than you're right and still be profitable. If a setup doesn't offer this ratio, we just walk away. It doesn't matter how good the entry looks. Your stop loss is your safety net. It is not optional. You always use one, and you place it logically, usually just below a recent area of support. Now, if the price hits your stop, you're out. That's it. No second guessing, no hoping it'll turn around. And a key discipline, especially for intraday trading, is you never carry a losing trade overnight. You accept the small, manage loss, and you move on to the next opportunity. All right, now for the fun part. Let's see how this all plays out on some actual charts. We're going to look at one example where the strategy worked beautifully, and another one where it didn't, which is just as important to see why risk management is your best friend. Okay, so let's walk through a successful trade. Imagine we're looking at our daily chart and boom, we get our first signal. The RSI pushes decisively right above that 60 level. This is our green light. It confirms the big picture trend has bullish momentum. Now, and only now, do we have permission to start hunting for an entry on the smaller time frame. So now we drill down to the 15-minute chart. We got our daily signal, so we're patiently watching. And then, there it is. The RSI on this shorter time frame also crosses above 60. That's our second confirmation. That is the precise trigger to enter a long position. And what was the outcome? Well, we entered the trade right after our two-step confirmation, we placed our protective stop loss just where it was supposed to be, and the market moved in our favor. The trade successfully hit our minimum 1 to 3 risk-to-reward target. This is a textbook example of the strategy working exactly as designed.
But let's be real, no strategy wins 100% of the time. It just doesn't exist. That's why seeing how a losing trade plays out is so incredibly important. So let's look at another one. Here we get a completely valid setup. The RSI crosses 60 on the daily, and then we get our confirmation on the 15-minute chart. We enter the trade following our rules perfectly. But this time, right after we get in, the market decides to reverse. Now, listen up, because this is the most important part. Our preset stop loss does its job perfectly. The price hits our level, we're automatically taken out of the trade, and the loss is contained. This is not a failure of the strategy. This is a success of risk management. It did exactly what it was supposed to do. It stopped a small, manageable loss from turning into a big, painful one.
Okay, let's wrap all this up. We'll do a quick summary of the key parts of the strategy and then talk about how you can actually move forward with this information. So here's the entire system in a nutshell. We use 2 time frames, daily for the trend, 15-minute for the entry. The entry signal is simple, an RSI crossover above 60 on both charts. And the 2 pillars of risk management are a minimum 1 to 3 risk-to-reward ratio and the mandatory non-negotiable use of a stop loss. That's the whole thing.
Now, this is a really vital piece of advice. While this RSI strategy gives you very clear signals, it gets even more powerful when you don't use it in a vacuum. Combining these indicator signals with a basic understanding of price action, things like support, resistance, and breakouts, can seriously improve the quality of the trades you take.
And that leads us to our final thought. No strategy is perfect, and every single strategy can be refined. So how could you make this one better? Could you maybe combine it with another indicator? Maybe adjust the RSI levels for different market conditions? The next step isn't to just go trade this blindly. It's to take these ideas, backtest them for yourself, and make them your own. Thanks for tuning in.